Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So, imagine walking into a casino, right?
Oh boy, a casino.
Yeah, but not a fun one. One where the games are rigged so violently that, people are just panicking and losing their shirts every single day.
Right, the absolute worst kind of casino.
Exactly. But there is this one specific table in the back where, if you just sit there long enough, the casino mathematically has to pay you.
I like the sound of that table.
Right. So today we are looking at how to actually find that table. We're going on a deep dive into this very famous, very old investing adage, the idea that investing is ultimately just investing in time.
Yeah, and I mean, it's a question that sounds incredibly simple. It sounds almost like a cliche you would, read on a bumper sticker or something.
Totally.
But when you actually look under the hood of the market right now, it is actually the absolute most critical question a beginner can ask themselves.
And really, the core mission of today's deep dive is to figure out the actual mechanics of how time interacts with your money. Because recent analysis of the market, and we're looking at data as of May 25, 2026, it reveals that time is indeed your best friend. But, and this is a huge but, only if you have the correct structure in place.
Right. Structure is everything.
Because for you, the listener, stepping into the market as a beginner right now, it might honestly feel like walking onto that overwhelming, incredibly loud casino floor. So we want to give you a clear, stress-free roadmap out of all that noise.
And that casino feeling, I mean, it is very real. If you look at the immediate present, simply holding on to your investments emotionally, like just white-knuckling through the chaos.
Yeah.
It just doesn't work anymore.
No, it really doesn't.
You cannot just close your eyes and hope for the best. You need a mechanical system.
Okay, let's unpack this. Let's break down the reality of the market right now in May 2026, because frankly, it is a little dizzying. According to research from Reuters, earlier this year, the S&P 500 was up 8%, right? And the NASDAQ was up 13%.
Massive numbers.
Yeah. We are talking about record highs, but at the exact same time, we are seeing intense short-term volatility.
Huge swings.
Right. There are market shocks driven by, the ongoing war in the Middle East, surging oil prices, rising U.S. long-term interest rates. Plus, you have the heavy valuation burden of all these massive AI stocks.
Oh, yeah. The AI hype is everywhere.
It's everywhere. And add to that the current political landscape. With President Trump in office, we are seeing ongoing significant shifts in trade policy and geopolitics. So I have to ask, if the market is hitting all-time highs under the current administration, why is there so much underlying panic and whiplash on a day-to-day basis?
Well, what is fascinating here is that this whiplash, it's the natural state of the market.
Really? Just natural state?
Yeah, long-term upward trends and short-term panics, they always coexist. They live in the exact same ecosystem. You can have a month where strong corporate earnings push the stock market to record highs, and literally a week later,
everything drops.
Exactly. Inflation fears and oil spikes pull it right back down. The goal of a long-term investor isn't to ignore this volatility or pretend it isn't happening. The goal is to plan for it. A recent analysis uses a brilliant analogy for this, actually. It's like planting a tree.
Wait, so you're saying the goal isn't to build like a concrete bunker to hide from the volatility. We're supposed to just let the storm hit.
Essentially, yeah.
That feels incredibly counterintuitive. I mean, my first instinct as a beginner is to protect my money at all costs.
It is counterintuitive, but think about the tree. You don't plant a tiny sapling in the dirt and expect to walk out your back door into a giant oak forest the very next day.
Right.
It is physically impossible. That tree has to survive winter freezes, high winds, blistering summer droughts, just to grow deep roots. Long-term investing isn't about standing in the yard enduring the stress of the storm yourself.
Yeah.
It's about planting the right kind of tree in the right soil so it survives all market weather on its own without your constant intervention.
Oh, okay. That makes a lot more sense. We can't control the economic weather, but we can completely control the root structure we build to withstand it.
Exactly.
And since we know the weather is going to be volatile, I mean, that is absolutely guaranteed, how do we actually use time to our advantage? Because the research points heavily toward the actual mechanics of compounding.
Yes. In investing, time is your strongest variable.
Yeah.
It's literally the sunlight for your tree.
Yeah.
The difference between investing for 10 years and investing for 30 years isn't just, 3 times the money.
Right. It's way more.
Because of compounding, the difference is mathematically explosive. But there is a massive psychological trap here.
What's
The
that?
first 5 to 10 years of compounding look painfully boring.
Yeah, I always picture compounding like rolling a snowball down a really long hill.
Oh, that's a good one.
Right. At first, it's just this tiny handful of snow. It looks completely unimpressive. You are rolling it, your hands are cold, and it barely seems to be growing at all. But by the time it gets near the bottom of the hill, it's a massive avalanche. I mean, it's picking up boulders and trees. But here's the catch. If you try to build a giant snowball all at once at the very top of the hill.
It's just going to fall apart under its own weight.
Exactly. It just crumbles.
That is a perfect way to look at it, and it brings up a crucial caveat. Starting early does not mean dumping all your life savings into the market today.
Especially not right now.
Exactly. Especially not with the May 2026 market sitting near all-time highs. Starting early just means starting small.
Right, because if I drop my entire life savings at the top of the hill today and the market drops 10% tomorrow, I've just lost a massive chunk of my snowball before it even starts rolling.
You're starting in the negative.
Yeah, so I should be feeding it slowly, right? Like dollar cost averaging.
Exactly, dollar cost averaging. That's when you invest a set amount of money, say $100, every single week or month, regardless of what the market is doing.
Just on autopilot.
Let's walk through the mechanics of why that mathematically protects you. When the market is hitting record highs, your $100 buys fewer shares.
Because they're expensive.
Right.
Right.
But when the market crashes and everyone else is panicking, your $100 automatically buys significantly more shares because they are essentially on sale.
Oh, right.
Over time, this smooths out the average price you paid. It entirely removes the stress of trying to guess the perfect day to buy.
So if the snowball needs a slow, steady, automated roll, what usually stops it, I mean, looking at the historical track record, what usually stops the snowball is our own impatience.
Oh, 100%.
It is this deeply human illusion that activity equals skill.
Spot on. We are wired to think that if we are doing a lot of things like trading, reading charts, reacting to the news every 5 minutes, we're achieving a lot.
Right, like we're being productive.
Exactly. But in investing, setting goals like, I need to make a 20% return in the next 3 months to buy a car, that isn't investing at all.
That's gambling.
That is gambling.
Yeah.
And the May 2026 market is an absolute minefield of daily temptations.
Oh, it really is. Every single day, there is a flashy new headline. AI, semiconductors, nuclear energy, gold, Bitcoin, defense stocks. It feels like you are missing out on a winning lottery ticket every single hour.
And that temptation has very real, very dangerous consequences. According to Financial Times reporting, Japanese retail investors recently flooded the Tokyo exchange, aggressively chasing AI and semiconductor themes.
Wow.
Yeah, trading volumes spiked drastically, and alternative trading platforms, which are basically gamified stock trading apps outside of your traditional boring brokerages, they saw massive surges in activity.
Just people chasing the hype.
It highlights how intoxicating the short-term chase can be.
I want to do the math on why that chase is so dangerous because it's actually terrifying when you break it down.
Let's do it.
So if I have $100 and I lose 50% of it chasing a hot AI stock on one of those gamified apps, I am down to $50. Now, to get back to my original $100, I don't need a 50% gain. I need a 100% gain just to break even.
Which is incredibly hard to achieve. You basically have to double your money just to get back to the starting line.
That's insane.
That is exactly why earning a boring, steady 6 to 8% over several decades is mathematically vastly superior to making 20% for a few years, getting overconfident, and then suffering a massive 50% loss that knocks you completely out of the game.
But here's where it gets really interesting, and I want to push back on this a little bit.
Okay, go for it.
Everyone wants to catch the next big wave of technological innovation. We see the headlines about these massive tech companies changing the world. Isn't sitting back with an automated, quote-unquote, boring portfolio just leaving money on the table when there is so much daily opportunity right now?
This raises an important question, and honestly, it is one every beginner wrestles with. But the short answer is no. You aren't leaving money on the table. You are keeping your money safe from yourself.
From myself. Right.
The true enemies of compounding aren't boring returns. The enemies of compounding are leverage, which means borrowing money to trade, thereby magnifying your losses, concentrated bets on a single hot stock, panic selling when the market dips, and high trading fees from constantly moving your money around.
So all human behaviors.
Yes. Automation removes the heavy burden of having to wake up and guess what the Federal Reserve or global oil markets are going to do today.
So it's about removing human error entirely. But, if a leaky boat will sink no matter how much time you give it, how do we make sure we're building a fleet that actually survives? Because there is this massive misunderstanding out there that time heals all investments.
Ooh, that is perhaps the most dangerous myth in finance. Time is medicine for good assets, but it is absolute poison for bad ones.
Right. Time heals all wounds, sure. But time doesn't fix a hole in the hull of a ship. Giving a sinking ship more time just ensures it hits the bottom of the ocean.
Exactly. Holding on to companies that are fundamentally losing their competitive edge, companies carrying massive unsustainable debt, or companies in shrinking industries. That will not magically make you rich just because you stubbornly wait 20 years.
Like Blockbuster or something.
Exactly. Think about video rental stores when streaming was invented. Giving a video rental stock another decade didn't help. The hole in the boat just got bigger.
So how do we, as beginners, avoid accidentally buying a fleet of sinking boats?
For the beginner listener, recent analysis strongly suggests that broad, diversified exchange-traded funds, or ETFs like global funds, U.S. large-cap funds, or quality dividend funds, these are the safest way to capture the overall productivity of capitalism.
So you're buying a basket of things instead of one thing.
Right. When you buy a broad U.S. large-cap ETF, you aren't betting your life savings on one specific boat. You are betting on the entire American shipping industry. If one company goes bankrupt, it simply falls out of the fund, and a new growing company automatically takes its place.
But even with ETFs, investing isn't just buy and completely forget, right? You still have to do some basic maintenance.
Correct. You don't need to look at the daily price fluctuations, but you must periodically check your underlying assumptions.
Like what?
Like, are the management fees on your ETF eating into your profits? Or has your portfolio accidentally become too concentrated in one theme?
Oh, I see.
For example, because AI stocks have grown so massively in value recently, a standard index fund might suddenly have a huge percentage of its weight in just 3 or 4 tech companies.
Oh, wow. So you think you're diversified, but you're really just heavy on AI.
Exactly. You have to rebalance periodically to make sure your structure is still sound.
Which brings up the need for a team of different assets. If we need a structure that survives for decades, we obviously can't bet on just one asset class or one single country being the absolute best forever.
That is the essence of a global all-weather perspective. Over a 20 to 30-year period, U.S. stocks won't always be the absolute #1 performer every single year. AI won't always be the leading sector. You need a portfolio that can handle entirely different economic futures.
Let's break down the roles of that team for the listener. First, you have stocks. These are the engine of growth. They capture human innovation and corporate profits over time. Then you have bonds and cash. These are the shock absorbers.
And the bond market is a particularly vital topic right now. Recent analysis from BlackRock shows that supply shocks, high yields, and general global uncertainty have fundamentally changed how bonds work in a portfolio.
Wait, really? Because I always thought of bonds as the mattress of the investing world. You just stuff your money in there so you absolutely don't lose it. Are you saying they are actually riskier to buy right now?
In a way, yes, if you don't know what you're doing. Let's look at the mechanics of a bond. A bond is basically an IOU. You lend money to the government or a corporation, and they pay you interest, which is the yield.
Okay, simple enough.
But bond prices and interest rates act like a seesaw. When new interest rates go up rapidly, the price of older existing bonds drops.
Why is that?
Because why would anyone buy your old bond paying 2% when they can buy a brand new one paying 5%?
Oh, duh. That makes sense.
Right. So BlackRock points out that people used to blindly throw money at generic bond funds for safety. Now, because of these rapid shifts, careful selection and focusing on the actual income the bond is paying you today is much more important.
But let me challenge this whole setup. If stocks are the ultimate engine for long-term growth, why should a beginner even bother with bonds or holding cash right now, especially when inflation is actively eating into the purchasing power of cash? Why not just go 100% into the stock growth engine?
If we connect this to the bigger picture, it all comes back to human psychology. Bonds and cash aren't there to make you fabulously wealthy.
Right.
They're there to prevent you from panic selling your stocks when the market inevitably crashes. If you are 100% in stocks and the market drops 30%, human nature screams at you to sell everything and stop the bleeding.
Yeah, you see your account drop that much, you panic.
But if you have bonds and cash acting as a shock absorber, the total drop in your overall portfolio is much smaller. It gives you the emotional fortitude to just sit tight, ignore the panic, and let time do its job.
That makes perfect sense. It's psychological armor. And then the third part of the team, gold and commodities. These are framed as insurance policies against systemic risks. And by systemic risk, we mean a massive shock that takes down the whole financial system, not just one bad company, right?
Exactly. Rampant inflation, geopolitical crises. Gold historically acts as a hedge when paper money loses trust.
Now, there is one more fascinating piece to this global portfolio puzzle: currency. The analysis highlighted a really interesting reality check about a Korean investor buying U.S. stocks.
Yes, this is a great point. When a Korean investor buys a U.S. stock like Apple or Microsoft, they aren't just betting that the tech company will go up in value.
What else are they betting on?
They are simultaneously betting on the strength of the U.S. dollar against the Korean won. They are making two massive bets at once, often without even realizing it.
Because they have to buy those stocks in dollars.
Exactly.
So to translate that reality check for our American listener, what does that mean for them when they're building their portfolio?
It proves a universal rule of long-term investing. Ultimately, you must hold the majority of your assets in the currency you plan to buy your groceries in and the currency you plan to retire in.
Wow. Okay.
For the American listener, that means while globally diversifying into international companies is great, your foundational structure needs to be anchored in the U.S. dollar. Because decades from now, your future liabilities, your mortgage, your medical bills, your weekly groceries will all be priced in U.S. dollars.
So what does this all mean for the listener today? Let's bring all this theory directly into their wallet, living in this volatile May 2026 reality.
The actionable steps are actually very grounding. According to a Reuters report featuring expert commentary, the current market volatility we are seeing, all the wild daily swings, is simply the market repricing geopolitics, interest rates, and trade policies.
Repricing, meaning the market is just digesting the daily news and automatically adjusting the price tags on every single company to reflect that new reality.
Precisely. It is a mathematical adjustment, not the end of the world. Therefore, it is absolutely not a reason to abandon a long-term strategy. The actionable advice is, don't stop investing, but control your speed.
Okay, let's make this highly specific. If I'm a beginner listening right now and I have $1,000 ready to go, what is the absolute first step I should take after this deep dive ends?
If you have a lump sum, whether it's $1,000 or $10,000, do not drop it all into the market tomorrow morning.
Because of the top of the snowball hill.
Right. Spread it out over the next 6 to 12 months. Set up an automated ETF drip, meaning you are buying a little bit every week or every month, regardless of the scary news headlines.
And specifically, don't rely entirely on massive AI stocks, because as we discussed with the valuation burden, a lot of the high expectations for AI are already baked into their current price tags. You are paying a massive premium for the hype.
Exactly. You want to mix in global indexes, value stocks, and dividend-paying companies. You want to participate in the entirety of capitalism, not just the hottest tech sector.
Right.
And finally, treat your standard brokerage investment account with the exact same respect and the exact same mental distance as a locked retirement account.
Right.
You wouldn't log in and day trade your 401k on your lunch break, so do not day trade your brokerage account.
Automate, diversify, and step away from the screen. So, to quickly recap the 3 golden rules we've extracted from the analysis today. Number 1, time is your most powerful asset, far more powerful than trying to perfectly time the market.
Absolutely.
Number 2, time only creates that compounding avalanche inside a good structure with good assets. A leaky boat will still sink no matter how long it stays in the water. And number 3, short-term volatility isn't a monster under the bed. It's not a signal to panic. It is just the natural cost of doing business in the market.
Beautifully summarized. And as we wrap up, I want to leave you with one final thought to ponder.
Let's hear it.
We've established that investing is ultimately about owning time. So look at your portfolio today and ask yourself, are the assets you currently own quietly working to give you more free time in the future? Or are they so volatile, risky, and demanding that they are consuming all of your time, stress, and attention right now?
That is a brilliant question to end on. If your money is stressing you out on a daily basis, you aren't owning time. Time is owning you. Thank you so much for joining us on this deep dive. Don't forget to subscribe and hit that like button.